Social Security retirement benefits are taxed like no other income in the United States tax code. Today, I want to unpack the tax implications of starting Social Security benefits. Thanks for tuning in. Hello, and welcome to another episode of The True Wealth Show. If we haven't met before, I'm Planner Mike, a certified financial planner professional and owner of True Wealth Financial. I believe their retirement should be prosperous, enjoyable, and purposeful. This is the show that's dedicated to helping Christians retire with confidence and clarity so that they'll be freer to serve God and live the life they truly desire. Today, I want to talk about the taxation of Social Security. I want to talk about why it matters, how Social Security benefits are taxed with a couple examples of both a single person as well as a married couple. And I want to give you 6 income streams that won't affect Social Security benefits. And as always, we'll close with a micro action to help you get one step closer to confidently retiring. But first, a disclaimer, or maybe a little bit of a caution. You never want to let the tax tail wag the retirement life dog. And that's how the True Wealth Total Retirement System was designed. The idea is you start off with a plan. What are your needs? What are your wants? What are your wishes? What are your wounds? What do you want to avoid? What does life look like when you're retiring? From there, we can derive a retirement income. How much do we need to pay for retirement that's sustainable and that will last a lifetime? We use that then to drive our investments. How's our investments for this stage of life? Because it's different than when you're just growing money. You have different purposes for your investments now. And then we want to do everything we can thereafter to reduce taxes. But notice we start with life and then we get to taxes. We don't start with taxes and work backwards into life. Secondly, public announcement number 2 is that the reality is that there's no seemingly tax relief coming for Social Security benefits. The one big, beautiful bill outline and construct has been released over the past couple of weeks. And while there's been a lot of changes for pre-retirees and retirees that we're going to do a whole show on in the future, no tax on Social Security doesn't look like it made the cut, at least today. So what I'm going to show you is still the presumable law of how taxation will be occurring for Social Security over the next however long. So why does this even matter? One of the largest line item expenses that a retiree is going to have in the future is that of taxes, right? Think about it. By this stage, a lot of people have their mortgage, which used to be their biggest expense, is paid for. The kids generally are grown and gone, and we know that those cost a lot of money, but those are gone now in the house. College generally is finished or finishing up, and it doesn't take that much to just have basic life. You have some utilities, you have some food, you have some gas, right? But that's really about it. Now, obviously, you're going to have your wishes and your wants, but those are discretionary that you have a lot of control and decision power over. But taxes, those must be paid. But unlike when you're working, you have a lot more control over your taxes in retirement because you have a lot more control over your income. You can decide whether or not to take some of those wants and wishes, for example. But here's the thing, too. In the tax code, there's a lot of cliffs, thresholds, and in this case, dependencies. So a cliff is the idea that if you go over that cliff, there's a big impact, right? It'd be like falling off a cliff. IRMA is a good example. So IRMA is the surcharge, the income surcharge that you pay more for premiums in Medicare, right? So everybody pays the same amount of money for Part B premiums unless you make a lot of income. And then you get to pay more for it, right? If you make $1 more and you go over one of those income limits by just $1, it could cost you thousands of dollars for the next year in Medicare premiums, right? So it's kind of a big deal. You make one extra dollar, but it costs you $6,000. Like, that's a bad trade. So you want to be mindful of those cliffs. Thresholds are the same way. They're just not as black and white. They're more gradual. Right? So in Social Security, for example, you're going to see today that there are thresholds. Once you go over these, there's a pivot or a change. And there's dependencies. So that's what makes Social Security income different is the amount of taxes, the amount of Social Security income that you're taxed has a dependency upon other incomes that you have, as we'll see today. So this is something you definitely want to be mindful of. Additionally, every dollar that you pay in taxes that you really didn't have to, that's one less dollar that you could save, one less dollar that you could spend, one less dollar that you could give, or one less dollar that you could invest to make more for the future. So you don't want to pay anything more than you have to, right? So I like to say, as good American citizens and patriots, we want to pay every penny that we legitimately owe to Uncle Sam, but we don't want to overtip him. We don't want to give Aunt Iris some extra money for good service, right? So again, you have a lot of control over your income and therefore a lot of control over your taxes in retirement, unlike you had when you're working. So this is one of those things that really change at this stage of life. So secondly, the amount of Social Security benefits that's taxed is really dependent upon three different factors. The first one being your filing status, generally either single or married filing jointly. The second one is how much benefits did you receive from the Social Security Administration? And then the third is how much other earned income do you have? We use those factors to create what's called a provisional or combined income. And that's what derives how much of your Social Security benefits actually gets taxed upon. So that formula for that is 1/2 of your benefits plus any what's called non-taxable interest. So this is things like interest that's not taxed federally, like municipal bonds or some savings bonds. And then we add in additional earned tax income. So we're going to run through a couple examples of this, first as a single and then also as married, and those thresholds, and see how it's calculated. So again, our formula is combined income equals 1/2 of our Social Security benefits plus our non-taxable interest income plus other income. So for a single person, on the first $25,000, 0 of it is taxed. On the next 9,000 or up to 34,000, 50% of it is taxed. Anything north of there, 85% is subject to tax. So let's do an example with Single Steve. Single Steve is getting his Social Security benefits. He's getting $30,000 a year, and he has no other income. So 1/2 of that is $15,000. He has no non-taxable interest, no other income. So his provisional income is $15,000. So anything under $25,000, which his is, 0 of his benefits, so none of this $30,000 will be subject to taxation. However, let's say that he also takes an IRA distribution of an additional $30,000. So now he has $60,000 of income for the year. Well, to calculate his combined income, we take 1/2 of his Social Security, so half of 30 is 15. He has no non-taxable interest, and now he has $30,000 from his IRA, totaling $45,000. So on the first 25, he will owe 0, right? So minus 25K, we have 20 left to go. He owes 0 on that. On the next 9, up to 34,000, right? He's going to owe half, so 50%. So half of that is $4,500, leaving $11,000. Anything north of that, he'll pay 85% of that. So we have $11,000. 85% of that is $9,350. We total them up. We get a total of $13,850. So of his $30,000, $13,850 of it will be subject to tax. Now, the nice thing is that Right Capital can do a lot of this heavy calculations for us and making it real easy, as I'll show you here. So in Right Capital here, we have Single Steve making $30,000 a year in Social Security benefits. And if we go to the tax details, we can see that while he's making $30,000 in benefits, none of it is taxable. And the threshold's right here, so you can see those same numbers, 25 and then 34, that's the 9. None of his income is taxable, going back to the 1040. But if we change this, where he takes that $30,000 distribution as well, as noticed here on line B, well, now of his benefits, 13,850 are taxable. And now he has some tax due, not a lot, still a little under $3,000 for his $60,000 of income. But we can see that the breakout here worksheet, we can see 13,850 of his total Social Security benefits is taxable. It doesn't mean that's how much tax he owes. That's how much of his benefits is subject to tax minus standard deduction, and then his actual tax bill is $3,000. So next, I'd like to move on to an example of a married filing jointly couple. But first, if you're finding this information helpful or valuable, do me a favor, hit that like button there. It'll let me know to do more shows like this. Plus, it's a great way to say thank you. So now the married thresholds are a little bit different. On the first $32,000, zero is subject to tax. From $32,001 up to $44,000, or essentially the next $12,000, 50% of that is taxable. And anything north of there, 85% is taxable. So let's say Rob gets $3,000 a month from his Social Security. So that's $36,000. And Rebecca, she gets $2,000 a month, or $24,000, for a total of $60,000. And they have no other income. So half of their Social Security is $30,000, zero non-taxable interest, zero other income, for a total combined income of $30,000. So under the first $32,000, zero of it is taxable. So of their Social Security benefits, 0% is taxable. So none of their $60,000 of Social Security benefits are taxable. Okay, let's say now they take a IRA distribution of $40,000. So they have a total combined income for the year of $100,000. Well, now one half their Social Security is $30,000. They have zero non-taxable interest, and they have $40,000 of other income. So their combined income is now $70,000 a year. Well, on the first 32, they pay zero, right? So first 32, they pay zero, leaving them $38,000. On the next $12,000 up to 44, they pay half. So on the next $12,000, half of that is subject to Social Security, leaving them $26,000. Anything north of that, 85% is taxable. 85% of $26,000 is $22,100. So if we add 0, 6,000 and 22,1, we get $28,100. So $28,100 of their $60,000 of Social Security benefits is subject to taxation. And again, the nice thing is that using financial planning software like Right Capital makes this very easy for us. Back here in Right Capital now, we have Rob and Rebecca. We can see that they're taking $60,000 in Social Security benefits, but none of it is taxable. Again, if we go to the worksheet here, we can see that because they're under that $32,000 from a provisional income perspective, none of their Social Security benefits are subject to income tax. However, if we go back to the 1040 and now we change this to where they're taking a $40,000 distribution, as seen here on line 4, now $28,100 of their $60,000 in benefits is subject to tax. Again, if we kind of go to the worksheet, we can break that out. We can see that now their combined income or provisional income is $70,000. In the first 38, they pay half. Additionally, after that, they pay a percentage. And so we have $28,000 of their Social Security benefits are subject to tax here. But again, overall, they're making $100,000 a year, and they're paying a little over $3,000 in tax. Not too bad. But here's the thing. Here's where it starts to get really cool. What if you had income that didn't count? So you'll notice that I said in there, in the provisional income, other earned taxable income. Well, there's some income streams out there that are not earned and are not taxable. And I want to give you 6 of them here real quick. So the first one is qualified Roth distribution. So if you have money that you take out from a Roth IRA, a Roth 401k, a Roth SEP, Roth 403b, etc., that money you essentially put in after tax and you got to grow it and it's tax-free. When you take it out, you will never pay tax again on it assuming it's a qualified distribution, which we'll do a whole show about those in the future sometime. Additionally, qualified health savings account distributions. So this is money you take out from a health savings account that's used for medical expenses or past medical expenses. We'll talk about that hack sometime in another future episode as well, where you can take money out and it's not taxable, right? It's to cover qualified medical expenses. Additionally, number 3 is that of return of capital, right? So this is the idea of sales from, generally as an example, like taxable investment accounts, like a brokerage account. You put money in, you buy an investment of some sort, it goes up, you sell it. You only pay taxes on the gain. And you, by the way, you get to pay those at a discounted, hopefully long-term capital gains rate. But the initial money that you put in to buy the investment, that's a return of capital. There's also, fourthly, things like excluded income. So a good example of this might be the sale of a primary residence, right? So a single person, $250,000, married filing joint couple, $500,000. That's how much money you can make on the sale of your primary house. There's obviously some rules associated with it. Ownership and use, for example. But you can get a lot of money on the sale of your property, personal property, that doesn't count towards this. Another thing is money that you receive from gifts or inheritance, right? So gifts, money that is given to you is not taxable to you. There's a annual gift exclusion of, I think it's $18,000 this year that someone else can give. And if somebody gives you more money than that, they're actually responsible for the tax, not you. Same thing with inheritance. Inheritances come to you tax-free because the deceased or the estate or whatever it might be pays the taxes in most cases. Lastly, life insurance proceeds, right? So life insurance, the death benefit of a life insurance policy that's paid out because someone dies, that's tax-free income, right? So there's 6, and that was just off the top of my head, 6 different ways you can get income that doesn't count towards this at all. As we conclude today, if you're finding this information helpful or valuable, please consider subscribing. That way you'll be notified of future episodes, plus it'll help get this information into the hands of others. Today, we talked about the taxation of Social Security benefits. Now, ideally, this should be considered in conjunction with an overall comprehensive plan, one that considers your retirement aspirations, goals, income needs, timing, and a whole lot more. I understand how overwhelming, confusing, and complicated this can be. If you have any questions, please feel free to leave them in the comments below or send it to mike@truewealth.show. But for today, a good micro action for this week might be to consider the utilization of a Roth account. Either getting an account open to start the 5-year clock running, or have a plan to do Roth conversions in the gap years, generally from the time where you stop working and RMDs kick in. I think it's important to start thinking about that about 5 to 10 years ahead of time. Remember, taxation of Social Security benefits doesn't look like it's going to be going away. And it has a unique structure all to its own. Anything that you can do to lower taxes will help your overall retirement plan. Hope this helps you on your path to a retirement that is prosperous, enjoyable, and purposeful. Till next time, hope you have a great day. God bless you. Thanks again for taking the time to watch this week's episode of the True Wealth Financial Show. I encourage you to like, share, and subscribe so you don't miss any future episodes. Additionally, you can find more information on our website at www.truewealth.show. One final note, though, as we wrap up to today's show. While I hope the information was helpful, valuable, and insightful, it's really for information and educational purposes only. Prior to making any decisions or taking any actions, I'd strongly encourage you to talk to your legal, tax, estate, or financial advisor who's familiar with the unique circumstances of your particular personal situation. Thanks again for watching, and until next time, hope you have a great day.